This is what we call a risk dashboard. There's a lot of information here. Basically, the bottom line is that the more you are in the red, the higher the risks. The more you are in the green, the lower the risks. So risk off, risk on, bottom line. And if you look across all the indicators here, we've got indicators of equities, bonds, credit, funding and liquidity, equity volatility, FX volatility. Typically what you've found, at least over the last 6 months or so, is that wherever you see risk off, it's typically been in emerging markets. Wherever you've seen risk on, it's been in advanced markets. So this big split between the advanced and the emerging world has been apparent across a whole bunch of different indicators. For example, you can see it here. If you look at credit, you can see emerging market yields, some of the CDS for emerging markets, somewhat in the red. But if you look at the investment grade and high yield in the US, fully in the green, a very big split within markets. Okay, let's think about why this might be happening. Why has there been such divergence in advanced and emerging economies over the last 12 months or so? Well, we need to think back to May of last year, and everybody remembers the Bernanke comments about tapering and how that started to worry people that the Fed were going to start tightening policy really, really quickly and perhaps faster than they thought. That had a really big impact on markets, particularly, again, emerging markets. And we think there were 3 phases to the period that followed those comments by Bernanke about the Fed starting to think about tightening policy. The first phase, and you can see it much clearer here actually, were these red bars. Now these bars show here the change in the sovereign CDS spread for all these emerging markets over different periods. So the first period from May to June of last year, roughly. The second period, the green, from July to end December. And then the third phase from January to March of this year. And then things have subsequently calmed down. There are 3 distinct phases. In the first phase, people just panicked and sold everything. So you can see that CDS spreads across all of these emerging markets all went up. There was no discrimination at all. Hungary, China, Turkey, it didn't matter where you were in the emerging markets world, they were being sold off. The second phase was a little bit more discriminating. So this was happening last summer. Then investors said, well, there's no reason to sell everything. Let's focus on those emerging markets that are most vulnerable. And those markets that were most vulnerable typically had large current account deficits and high inflation. And there you can see the green bars. So actually we saw quite a bit of a rebound, sovereign CDS spreads falling in some markets, but rising in others. Indonesia, Brazil, Turkey, the so-called Fragile Five, which you probably remember from reading the newspapers. And then at the start of this year, we had another emerging market sell-off. And this time it was even more discriminating. So now markets really just focused on country-specific risk. And you can see really it was driven by maybe some concerns in China. There were some issues in Argentina and Ukraine. But again, overall emerging markets were much more stable. So we've seen a lot of emerging market volatility over the last year. But you can see that each type of shock elicits a different type of reaction. And clearly the most worrying aspect was this red period, when the Fed first started to say it was going to tighten policy. And you can see the impact that the US financial conditions have on investor confidence and investor flows into emerging markets. At the same time, emerging markets and emerging economies took a lot of measures to try and stem all that volatility when it happened. So these dots basically give you an indication as to what policies were changing in these economies. You can see listed across the top the major emerging markets during the last 12 months or so. So you can see as volatility picked up, they started doing lots of stuff, hiking rates, consolidating fiscal, doing macroprudential, and then it stopped. As soon as the volatility declined again, all of this adjustment, these policies to generate sounder fundamentals stopped. So what we typically see in emerging markets is these governments and central banks respond to volatility, but when the pressure comes off, we see much, much less reform, we see much less positive policy momentum. Okay, so that's just a little bit of background. Let me now just touch on the US and how we're thinking about the outlook for US financial conditions and what the spillovers of that might be. And there's been quite a lot of action in the US that's been quite unique to this cycle. Now, if we think back to, again, this time last year, this famous taper tantrum, what we saw was a period, the blue line here, when 10-year Treasury yields went up quite significantly. They went up 150 basis points very, very quickly. But that was not the only thing that was happening. We also saw that change in yields being driven by short-term interest rate expectations. So it wasn't just the fact that people believed that QE was coming to an end, they also felt that the Fed was actually going to start hiking interest rates pretty soon. And that got people very worried. After this period, the Fed seemed to have done a much better job of communicating what they're trying to do. So they've told us that, you know, just because we're phasing out QE, we're tapering, it doesn't mean that we're going to raise interest rates. And they've been very successful in doing that so far. So you can see that 10-year Treasury yields stayed high, but expectations of whether the short-term interest rate will be in June 2015 fell and have stayed stable ever since. And that, to a very large extent, explains why volatility, global volatility has declined and has stayed low over the last few months or so. This is also helping facilitate financial repair in the US. So we've seen balance sheets in the US really start to improve quite a lot for households and banks, and that's starting to show up in the flow of credit from the banks to corporates. So the banking system in the US is starting to work again, and of course that's showing up in real economic activity, where we're seeing a pickup in economic growth more broadly. So that's the good news from the US. What's the less than good news? Why should we worry? And as I said before, we're paid to worry, so we can always find things to worry about. I'm going to give you some things to worry about right now. First of all, if you look at the equity market, you can look at various valuation measures, and we're not equity strategists. We don't care whether the market goes up or down. We just worry about periods of very excessive volatility that can cause spillovers globally. But it is true, from our perspective, that if you look at a very simple PE, and we like the Shiller PE, takes a sort of much longer term look at equity markets, that so far is pretty high for this point in the cycle. So valuations in equity markets seem certainly not cheap at this point. And if you break down the composition of returns over the last 12 months or so, you can see that it's been very much driven by a decline in the equity risk premium. So people are just taking on more risk. We haven't yet seen equity markets being driven by earnings. Now that may happen, but it needs to happen if equity markets are going to stay at close to current levels. What's perhaps even more interesting, though, is on the corporate debt side. This is where we've seen a lot of action in the US. So here we have a chart which shows quite a lot of information, actually. This is some indicators for the non-financial corporate sector in the United States. And it shows where we are today, which is the dark blue bar. And where we are today is about 4 years after, if you can see right here, 4 years after the peak in high-yield corporate defaults. So that was like the bottom of the cycle. We're 4 years after that period. The light blue bar is the average of the same point in the cycle over the last 40 years. So where do we stand in this cycle compared to previous cycles? Well, first of all, you can see the capital expenditure by firms is lower, so they're investing less. Typically at this point in the cycle, you're seeing more investment by firms. But at the same time, they're investing less, but they're issuing more debt. They're issuing more bonds, they're borrowing more from leveraged loans, they're borrowing more from banks. So what are they doing with the money? Well, they're buying back more equities now than they have in previous cycles. And of course, what's the result of that? Higher net debt. So what we've seen is a process in which the non-financial corporate sector in the US is taking advantage of abundant liquidity and low interest rates to borrow, but not to invest. I mean, there is some investment going on, of course, but they are increasingly buying back their own equity and increasing their own leverage. You can see that over here, actually, from this chart. You can see this net debt to total assets. In the previous cycle, at the bottom, we were at about 17, 18%. Right now, we're at 22, and we're at the start of an economic cycle. So you can see that net debt to asset levels are pretty high for this point in the cycle. That's not the only thing that's going on in the US. The other thing that's going on, and this is a global phenomenon, and a lot of people really focus on China when we talk about shadow banking. But of course, shadow banking is happening everywhere. And it's happening everywhere to some extent because the formal banking system is being increasingly burdened by lots of regulation. Some of it good and some of it bad. But the result of all of this regulation and a very cautious approach by banks is that non-bank financing is increasing. So you can see here that the blue line is bank loans to non-financial corporates in the US, and the red line is non-bank loans, leverage loans, all sorts of syndicated loans. And you can see right now that it's the red line that's providing most of the financing. Very different from what we've seen in the history. Much more financing than the formal banking sector. In fact, bank loans as a percent of total bank assets has either been stable or falling in most cases. At the same time, if you look at syndicated loan transactions with what we call weak underwriting standards, so there are no covenants, or there are other weak aspects of the loan in the sense that they don't require a large amount of collateral, then you can see the proportion of those syndicated loans transactions with weak underwriting standards has risen from about 10% to around 1/4 of all syndicated loans. So in this search for yield, in this low interest rate environment, people are taking a little bit more risk. And the longer rates stay low, the longer this process continues. If you look at the debt to earnings ratio for highly leveraged loans of the borrowers, you can see again we're approaching pre-crisis levels. So memories have been pretty short. And who's buying this stuff? Who's buying all these syndicated loans? Well, more and more it is not institutional investors that perhaps do a lot more due diligence, that perhaps look through the books, understand the risks, have been through these cycles before. More and more, it's retail investors, mutual funds, ETFs, and households. So they go into their bank, they're getting 25 basis points on their deposits, and they're not happy. But there's a mutual fund or an ETF that's invested in leveraged loans that's giving you 4%. And that's where we're starting to see a lot of the money flow from households through the shadow banking system to pretty highly indebted portions of the US corporate sector.